All right, did you see that the 10-year went over 4% this week? It's bananas. I mean, truly, it does not make any real sense. A lot of things are not making sense right now, so that's the tough part about the market. For example, that ADP wage report that came out last week was just completely off and wonky. The general consensus is that they think a lot of the people who, do the adjusting for the seasonal adjusting basically just don't really know how to do that post-pandemic. Still, they're having a hard time with that. So it just doesn't make sense. Right now, the 10-year is sitting around 396. It has come down below that 4% mark, but the longer it stays above that 392 kind of threshold, the higher the chances are that the 10-year treasury is going to 4.25, that will be the new threshold. So anyways, we will see what happens because we have a lot of big news coming out again this week. We have CPI and PPI coming out this week. So CPI is expected to fall to 3.1% from 4%, and the Fed is talking about a rate hike. So we basically have a 93% chance of a Fed rate hike on July 26th. So it's pretty much going to happen. I guess there is potential that CPI and PPI could come in lower than even forecasted, and perhaps that could change the forecast. But pretty much the market has said, okay, we're getting another hike in July and maybe one in September. So there's like a 24% or 26% chance of a hike in September after their summer break in August. So we'll see what happens with that. Now, the thing is, it's really interesting that they're even talking about doing this hike because a lot of the numbers have come down and the other thing that some economists are starting to say is going to be factored in is shelter, right? Because we all know that there's this lag in shelter. So we've all been waiting patiently. Why? Because a lot of times tenants sign a 1-year lease, right? So if rents are dropping and cost of shelter is going down, we're not going to know that for a year because they're locked into this 1-year lease. And when the lease rolls over is when you're going to start seeing people moving, having to drop rents to get new renters and all that sort of thing. So that is forecasted to hit finally CPI. So we should see that, and perhaps we might come in a little bit lower than forecasted. There is an economist that is forecasting that will come in at 2.7 versus the 3.1% that's estimated. So we will find that out on Wednesday. But headline inflation has dropped 6% in 1 year. I mean, hello, that's really good. That's a lot. That's a lot of progress in 12 months. And also the jobs report that we got on Friday showed the fewest jobs gained since December 2020. So the jobs are going down. Jobs gained are going down drastically every month. We're making good progress on this. So it is still, we're talking about doing another Fed rate hike. It's just very interesting. I was watching a news clip from Danielle DiMartino Booth. We've had her on the podcast before. She was on the news the other day and was just saying, I think the Fed is just intent on raising rates. He basically wants to pick and choose the information that serves this narrative that he needs to continue doing rate increases. So he sort of just seems hell-bent on doing it regardless, which means that it's going to delay rate cuts, unfortunately, for all of us. That said, PPI is considered the leading indicator because they come earlier in the supply chain. So 1 year ago, headline PPI was 11.2%. It's forecasted to come in at 0.4% on Wednesday. You guys, it's basically going from 11% to 0%. This is what we're talking about. And still, we're talking about raising rates another quarter. So core inflation, of course, matters more to the Fed. That is the metric that they use. 9 months ago, core CPI was 6.6%. It is forecasted to come in around 5% on Wednesday. So we've made some progress there, but they just feel like it's not happening fast enough. Obviously, this is what he's hanging his hat on and why he's saying that we're going to increase rates. They're going to do another 1 to 2 increases. So core CPI, though, was 8.3% a year ago, and it's now forecasted to be 2.6%. So there's a lot of big numbers that are coming out in the data. There's all these different types of core PPI and core CPI and all these kinds of different numbers that we're looking at. And most of the metrics are showing that we have aggressively dropped prices. However, it just doesn't seem to be good enough off for the Fed. And they do have a reputation for taking things too far, which it seems like they're going to do in this case. Also, like I said, 93% chance we're getting a rate hike July 26th and a 26% chance that we're getting another rate hike in September. So that being said, the market is skeptical of this soft landing because, like I said, the Fed has this reputation of taking things too far, and it appears he is doing so now. At least there's a lot of economists and very successful business people who look at data who also feel the same way. And like I said, they seem to be repeating the mistakes of the past, which is taking it too far. Although they are scared, we don't want to have like another 1970 situation where this inflation just goes on forever for an extended period of time, and you can't miss the mark on getting inflation down. So this is why they're going to be aggressive and make these increases as much as possible. And they're probably gonna do another 50 basis points increase, it's looking like at this point. So there's a lot of Fed speak happening this week prior to CPI and PPI readings. So people are going to be watching that. And then we'll be looking out for those reports on Wednesday. But what does all this mean for lending? Okay, so I talked about what kind of transactions I was seeing last week. This week, I'm going to touch on what is actually getting done in the way of financing. So as we talked about, multifamily has slowed down quite a bit, generally speaking, just because cap rates are still relatively low compared to where rates are. And like I said, this rise in treasuries is not helping the interest rate situation either. That being said, banks are being very conservative right now because they are sort of anticipating a lot of new changes to the laws happening since some of these banks failed, right? SVB and our beloved First Republic Bank and Signature Bank and all of these banks, even though they say that the banking system is sound, it is far from it. So a lot of the banks are really nervous about hitting the targets that they're going to, or hitting the requirements that they're going to place post bank failures to, try to avoid this from happening in the future. So a lot of banks are trying to shore up their balance sheet and they're trying to get more deposits and things like that. So a lot of lenders, if they're lending, are requiring deposit relationships in order to even consider doing a loan. I'm also seeing some of our lenders are actually requiring deposit relationships where it was in the LOI, it was in the loan docs, and they're like, don't worry, we're not going to really enforce that. Well, guess what? They are. One of my banks did that to me too, that we have some apartment financing with, and they're not really the greatest to bank with. In fact, I've heard nothing but horror stories, but now I have to move my operating account over to them, which I got a 3.1% interest rate. So sometimes you have to play the game. So when I have clients call me and cry about, this bank sucks and the banking is terrible and I don't want to bank with them and they're forcing me to, it's kind of like, okay, let's walk it back. I know that this sucks. It's a complete inconvenience, but would you rather do that and keep your 3% rate, or do you want to go refinance and pay a 6.5% interest rate with another lender, 6.25%, whatever it ends up to be, just because you like them more? I don't think so. In my experience, nobody's going to pay twice as much on interest. So sometimes you just have to look at the glass half full, appreciate what you got, which was a really, really low interest rate, and, pay your dues by moving your operating account back over to the lender to appease them so you don't go into the default rate, because that's exactly what they can do if it's written in the loan docs. So I am still seeing some long-term, stabilized financing. It's out there. It's available. We are doing some of it, but a lot of people are locked in for another year or two. So it's going to take some time for that to filter out. I am seeing people trying to buy, but it's just not making a lot of sense with the financing, because obviously higher interest rates means that you have to come in with more down since cap rates are still relatively low. Bridge financing, it's out there, it's available. A lot of times it makes more sense to go private money because private money is not that much more expensive than the banks at this point, and they'll get a little bit more aggressive. So most bridge lenders will tell you that they're doing bridge, but you're getting to 60, 65% loan to cost or loan to value, depending on who the lender is. So it's not really that great. You're definitely having to come in with more cash. So that's it for multifamily. I'm doing some crazy stuff though, you guys. For example, I've got a client who is developing, he's going to build 175 units, but his project got delayed. He has a private money loan on the property. It's just land, right? And the permits are pretty much approved, not quite, but they're close. And there's some litigation, right? So you would think that financing wouldn't be available available. Guys, I've got a loan. I shopped the heck out of this thing. So this is the thing. Like, this is where mortgage brokers become much more valuable, is that you have no idea these days who's doing the loans, because it's not a lot of the people that you've heard of. It's not a lot of the common players out there. There's a lot more like small regional banks, credit unions, that sort of thing doing them. And then in the case of this land loan, I mean, even most private money lenders didn't want to take the risk on this. In fact, one of the lenders that I went to that actually ended up coming back with an offer went to 40 different investors, and they all said no, but one guy. Okay. So this is what's happening. You have to work a lot harder to find deals these days, but they are getting done. So like I said, I've got a land loan. I'm doing a land loan at like 65% loan to value, which is insane. So I'm not saying I can do it for you, but I am saying when the situation is right, when it's the right deal, the right location, the right borrower, all of that, it is still possible to get done. It's just a lot more work. It's a lot harder to find. It's like looking for a needle in a haystack. So, and like I said, rates are just like, the range is all over the place. Rates and terms and max LTVs and that sort of thing. They're just all over the board, but we are getting that deal done. SBA owner user, that's still available. Kind of like the good news about that is, yes, rates are higher, it's more expensive, but those deals can still get done. They can still get financed in today's environment, especially because banks love the fact that SBA is guaranteeing a good portion of the loan. So that helps lenders to be more confident. Do they want your banking relationship? Absolutely. They did before things started getting tougher. They definitely want it now. So you do have to have a banking relationship. And I think that's the least that we can do if the lender's going to give us competitive financing or a good loan, right? So hotels, that's a tough property type. We talked about it last week. So a lot of people are trying to negotiate seller carries. That's cool. That'll get you by for a year or two, but those sellers do eventually want to be paid off. And what kind of financing is available for those? Well, SBA is a good option, just depending on how you are structured. It's not that every hotel can be financed through SBA. Otherwise, there are some small banks out there that can do the hotel financing. And the types of hotels that we're financing right now aren't non-flagged, okay? They're not like flagged like Hyatt, Hilton, Residence Inn, like none of those. They don't have any flags, okay? So that is good news for people because like I said, a lot of those Airbnb investors are kind of shifting over to that boutique hotel model so that they don't have to worry about rules changing and laws changing and all that good stuff. Industrial is obviously a strong property type. It's really proven resilient over the last 2 recessions now. So it's still resilient. Lenders love industrial. Different sectors or different types of industrial having a little bit more problems than others, but overall it's a very strong market and there is financing available for that. Office, obviously less desirable. Office is struggling just across the board, and all of the talk of all those loans, the CRE loans that are coming due, a lot of the concern is coming from office. There is some concern with the other property types, like let's say construction to perm, right? The perm financing for construction, and even multifamily where, you know, somebody bought the deal 3, 4, 5 years ago and it might not debt service now, especially if they had like some interest only included. It might not qualify now because rates are so much higher. So there are some things like that. Retail, I would say, is like medium appetite. It's not quite as hot as industrial, but it's definitely not as down in the dumps as office. So retail is doing okay, and there are lenders out there for that, but we really, really pay attention on retail to the leases, okay? So whether it's office even and retail, we want longer term leases in place. Lenders are trying to mitigate their risk. It's like the average vacancy period for retail is something like 2 years, okay? So that is why lenders really pay attention to lease rollover when it comes to office and retail, because they are really trying to gauge their risks over the loan term of you being able to continue making the payments. So retail, that is like the big thing that we pay attention to. And that's really tough because there's a lot of small mom and pop owners here, especially in San Diego too. I mean, all over, but they want month-to-month leases because they want the ability to get rid of a difficult tenant if they need to. But that sort of shoots you in the foot when it comes to lending, because lenders like safety, and safety means long-term leases in place. So that's kind of like the environment for lending right now. In terms of the bigger deals, what I mean, when I say bigger, sometimes it could be 5 million, but definitely 10 million plus. The agencies are really the biggest player right now. It's not the best option. It's not the best environment, but that is the best for what's available right now. And it is times like these that I see the agencies doing more of this types of financing in major metropolitan areas like San Diego, LA, San Francisco, because generally speaking, we have a lot of bank options, competitive bank options out there. Well, we have less now. So now we're looking at not only like, you know, banks, regionals, larger banks, credit unions who could possibly do some of these larger deals, but we're also looking at the agencies because they might offer longer interest only periods, for example. The rate could be, you know, roughly the same, maybe slightly higher, slightly lower, but interest only periods periods are the biggest thing that's kind of been the most painful for multifamily, is because we were so used to getting all that interest only financing, especially when we first buy a property and we're putting all this money into it. But right now, lenders, they'll give you IO, but they're looking at more on a case-to-case basis. They're looking to have a better reason now for IO. They're shortening up the IO term. So it's not as easy to get as it was previously, which is sort of ironic, right? Because now would be like probably the best time to give people IO, to give them some breathing room, especially with these high rates, and to make deals make more sense. But it has not changed so far. So anywho, this is my market update, you guys. Thank you so much. We have a ton of big news coming out this week, so I will report on all of that next week, and we'll see what the heck it does to these crazy treasuries. It's kind of already priced in, but who knows these days? The treasuries are sort of I wish I had my crystal ball to tell you what exactly was going to happen, but it is looking like now, if the Fed goes through with another 2 rate hikes, the more rate hikes he does, the longer this is going to prolong rates coming down, right? So it's going to take longer for rates to come down if he keeps hiking. It's just going to get pushed out into the future. So it's looking like this might be our reality, and we have to start planning accordingly or watch the market adjust. Maybe prices are going to come down a little bit more. I don't know, because they just haven't reacted the way that we needed them to, sort of like they did in the last recession, the Great Recession that we talk about, but they just haven't come down like that because of inventory, right? We've never had so little inventory. So inventory is keeping prices up, which is just causing this sort of perfect storm that the Fed is having to really, really feel like they have to raise rates because people are out there still buying. I mean, on the residential side, there are bidding wars, you guys, still bidding wars on properties. It is insane. I don't know where the money is coming from, but there's so much pent up demand, and so many people in that average buying age, they just want to buy a home. Like, that's what they want. So they're like hell-bent on doing it. So this is causing inflation to stay higher for a little bit longer, the Fed to feel like they need to hike rates because it's just not slowing down enough. So anyways, I will talk to you all next week. Have a fabulous week, and I'll see you then.